our topic for today is international funds. We're going to talk to you about what international funds are, why you should invest in them, and what you should be careful about. So, international funds are basically offered by domestic asset management companies for investors who want to diversify into equity stocks and equity funds other than what is available in India. So, say you're missing out all that action on those FANG stocks or what's happening in China, for example, in the Chinese equity market, then you can actually go to an international equity fund which is available right here, and you can invest in rupees and get that exposure. So, what mutual fund companies do is that they offer a feeder fund structure. They don't actually go and buy the stocks from that market and create a portfolio like they would for a domestic equity fund. What they do is go and partner with a fund that is already existing in one of these global markets, and they bring that partnership to India and they offer it to you through a feeder fund. This fund will invest only in that existing fund in the overseas market. You can invest in the Indian fund in your rupees, you can invest in rupees, and you can redeem in rupees. So this is how you can get exposure to the international markets. There are lots of options available, right from US, Europe, Chinese markets to Brazil, to different kinds of themes like gold mining companies, energy companies, or technology companies. So these are, or there are even funds which are diversified global funds, so not specific to any one region. So there is a lot of choice out there, but there are some nuances about international funds that you should be aware of before you go ahead and take the plunge. So why are we talking about international funds? Firstly, because they help to diversify. You see, sometimes when the Indian market is not doing so well, there are things happening globally which can actually, add a kind of balance to your portfolio. And also remember, you are investing here in rupees, but your rupees will get converted into the currency of that international fund, and then when you redeem, it will get converted back into the rupee. So as you know, in the long run, rupee keeps depreciating, and currencies of Western economies like the dollar or the euro keep gaining against the rupee. So this can be a good way to, you will benefit from the rupee depreciating and these other currencies appreciating through these funds as well. So while that is not the primary reason to invest in international funds, this kind of investing can give you a good balance in your existing portfolio, which may be too concentrated into Indian companies and Indian equities and bonds. So that is why we invest in international funds, for diversification. Now, what are the nuances that you should be aware of? Firstly, remember we said every investment has a cost and you should be aware of the cost. International funds or feeder funds offered by domestic asset management companies have a cost which is not too high. It can vary from, say, 15 basis points, which is 15 paisa to 100 rupees, to 1% or 2%. Anything between 1.5% is good, because that's how much a domestic equity fund also charges on an annual basis for its funds. So, international equity funds, feeder funds, which are coming to you at 1.5% kind of annual expense, are good enough. Secondly, you should be aware that these are not considered as equity funds. They are considered as non-equity funds, simply because they invest internationally, and there is a whole rupee angle to it. So the taxation is also non-equity taxation, which is similar to how debt funds are taxed, which means that in the short term, whatever your capital gains is from a period of 1 year to 3 years of holding, you will pay at your income tax rate that is applicable to you. Anything above 3 years of holding becomes long term, and there you pay an indexed capital gain, which is actually quite a good proposition. So I just wanted to let you know that the taxation is different from a regular equity fund taxation. Now that brings us to returns. Of course, there is a lot happening in things like US equities. The S&P 500 has done really well, and some US technology stocks have done really well. So these things can actually add to your portfolio, and you may be feeling that you want to get a little bit of that. So returns are there for everybody to see, but there are also very high risks. Now remember, this most of this is investing in equity, so it remains a long-term asset, which means you have to give yourself at least 5-7 years, 10 years even, to remain invested in international equity funds. When you're investing in an international geography, for example Europe, there the economic growth is actually stagnating, so you are taking a risk, because there, if economic growth is stagnating, then are the equities going to be able to deliver? If you want to invest in Japan, you're taking a different kind of risk. If you want to invest in the US, there is another different kind of a risk. So there is a lot of different kinds of risks at play here, because the economies you're investing in are different. They're in different stages of growth. Also, you don't know. So there is the risk of uncertainty. Also, there are several themes. There is a lot of variety out there as far as international equities are concerned. There is a international energy fund that you can invest in, gold mining companies, you can invest in Brazil. But do you know that had you picked the Brazil fund in the last 1 year, you would be sitting in heavy losses because that economy is not doing well at all? Had you picked the energy fund in the last entire decade, you would be sitting on, flat returns or perhaps losses, because energy companies world over, traditional energy companies, are losing out to renewable energy companies, and the thought process is changing, and so those stocks are really not doing well. So there is a lot of variety. You have to make your choice very carefully. You can get single digit returns, or you can get like 20%, 30% return in a year, or in 5 years, depending on the choice you make. So that brings me to the last part of this video, which is that international equity funds are really not meant for everybody. They are a good tool to diversify your portfolio. But if you're a first-time mutual fund investor, if you have not had any experience with stocks or market-linked equity mutual funds, then it's better to stay out of international funds, because the risk they add to your portfolio is going to be more, and you may not be able to digest that just yet. Wait for 5-7 years till you have built experience in market-linked products and in investing in equity, and then perhaps look into international funds. If you are a seasoned equity investor in the domestic market and you know what you're doing when you invest in stocks and mutual funds, then you can look at international equity funds, but don't invest more than, say, 5 to 10% of your portfolio in that. And also do your research thoroughly. Be sure about the specific geography that you want exposure in, or the type of stocks that you want exposure in, and be ready to take the risk that comes along with them, because globally, a lot of different things are happening, which could be different from what you're exposed to in India. They are available in both the regular and the direct option, so you can buy directly online through something like a FYERS Direct, or you can go through any other route that you choose. So there you have it. International equities help you diversify. They give you this kind of play over the rupee and international currencies, but they come with high risk, and they require you to do a lot of research and homework before you get into them. It's a great trend, but do your homework first.